Hello and welcome to Livewire Markets. My name is Anna Dadich and I'm joined by Sarah Shaw, Global Portfolio Manager at 4D Infrastructure. She is going to be talking to us today about the market shifts and growth drivers shaping global infrastructure. Hi Sarah, thanks for joining us.
Thanks for having me.
So we'll start off with what geopolitical issues are you keeping an eye on and how do they affect global infrastructure?
Clearly, Trump 2.0 is the big unknown, both geopolitically and at a macro level for 2025. His policy campaign was very much focused on tariffs, immigration, taxes, and clean energy. And he hasn't really halted in that view. As soon as he took office, he really started implementing policies towards his end goals there. And in particular, I think the latest has been the tariff announcements and Liberation Day on the 2nd of April and the ultimate backtracking. Infrastructure itself has characteristics that should be relatively resilient in this sort of environment. Its characteristics really support long-term, visible and resilient earnings streams. As such, it should look pretty good relative to general equities in these markets. We also have a great deal of diversity within our universe, both at a sector level, at a country level, and also from a macroeconomic standpoint. However, that's not to say we are going to be immune to what is happening with Trump's policies. Very clearly, we are going to be impacted, and the biggest risks I see are to the US market itself. We're clearly going to see some ports and rail volumes brought forward as a result of the implementation of tariffs. Yeah. And then over time, we'll probably see a reallocation of trade routes away from the US. So again, going to be impacting those port and rail companies in various destinations. Also in the US, we'll have some supply chain issues which will really impact things like renewables and the build out of new clean energy. And finally, I think interest rate dynamics will have an impact as well. Elsewhere in the world, we aren't immune to what Trump's doing, but it's much more fragmented. Europe's got slow growth, but stimulus. China's very sluggish, but really looking at stimulus again. By contrast, parts of Latin America are doing really well and are facing inflation and actually could be a beneficiary of Trump. So I think the way we think about it is the volatility, the noise, it does create a huge sentiment shift and it's very frustrating. But at 4D, we've got to look through that volatility to the real fundamentals and we continue to invest against those fundamentals and for the long-term growth opportunity that infrastructure presents.
Speaking of the changing rate cycle, how has it affected your portfolio?
It's a big unknown and it's very relevant to infrastructure. We are considered in some parts, in some places to be a bond proxy. And there are elements of the infrastructure universe that are very highly correlated to the moves in interest rate environment. So that is the dynamic that we have at play globally at the moment. Europe is seeing a declining interest rate environment, which is supportive for a lot of infrastructure investment. By contrast, in the US, we don't really know what we're facing. We could have a stagflation environment where sees interest rates go back up and inflation high. That's quite negative for parts of the infrastructure space. By contrast, if we avoid a recession, but we see interest rates move down, that is very supportive of infrastructure investment and returns. So the interest rate dynamic is a big unknown. We clearly, parts of the universe do better in interest rate rising and others do better in falling environments. And that's the beauty of infrastructure. In that macro diversity, we can position accordingly.
Obviously, Liberation Day had an impact on the sector early on. So what changes do you expect going forward?
I wish I knew. It is very fluid. Clearly, Liberation Day was a disaster in terms of the headline tariffs. Wound back very, very quickly. We are really sitting in a 90-day period of uncertainty at the moment to see what trade deals are done and what gets implemented and what doesn't. I think our base case is that we're not going back to Liberation Day style tariffs. There will be some softening of that stance, as we've certainly seen. I think the frustrating thing in that 90 days is a little bit of a standstill. No company, no consumer, no country is really looking to invest or move forward in a strategic direction until they know their starting point in terms of tariffs and the future relationship with the US.
Infrastructure is a diverse sector and often misunderstood as a bond-like investment. Can you outline the two key subsectors with examples?
Sure. So all of infrastructure assets are underpinned by some key characteristics which give you long-term, visible and resilient earnings stream. But within that universe that is infrastructure, we have two very economically diverse subsectors. On the one hand, we have what we call essential services, or your regulated utilities. These assets are largely immune to economic shifts, both up and down, as a function of them being a basic need, as well as the structure of their regulatory environment, which measures returns independent of volume or demand. These are the assets that actually do really well in weak economic and growth environments because they're still going to report earnings and a yield, even in the weakest or most depressed of economic demand. They also benefit from an interest rate declining environment because their regulatory return is correlated to that. On the other hand, we have what we call user pay assets. These are your toll roads, your airports, your port, your rail companies. These assets are 100% correlated to economic activity. So GDP drives your demand or your volumes, and you have an explicit inflation hedge. So you are completely protected from the inflation uptick that we have seen over the last couple of years. These are the assets you want to be exposed to in buoyant economic environments where GDP growth is strong, where demand is strong, where there's high inflation in the market because you're getting a hedge. So by actually being able to actively position between those two subsectors within the infrastructure space, we're capitalising on those resilient earnings, but also capitalising on the short-term in-country cyclicals of whether that be interest rates moving up, down, inflation being evident or not. And that's a real beauty of the infrastructure asset class.
Okay, so which subsectors and industries tend to perform better in this type of market environment that we're in right now, and why?
Generally, we would be having a global environment that seems to move in lockstep. We've got a very fragmented environment at the moment. And this is, again, a beauty of infrastructure is that we are regionally diverse as well. We have exposure to developed Europe, America, Asia, emerging markets. So we can capitalize on those economic dynamics in country. And that is particularly relevant today because in Europe, we have interest rates moving down. So we like the utilities in the European space, but demand is remaining relatively buoyant. By contrast, in the US, we have this situation where we could have inflation and stagflation. That's the one scenario that's not good for the US infrastructure sector. By contrast, in somewhere like Brazil, where inflation is quite elevated again, we're really capitalizing on that in the user pay space, where they're actually capturing the demand as well as the inflation.
Okay, so how is your portfolio weighted towards these?
Yeah, so we are currently overweight Europe, and that is largely utilities and user pays in various markets. We are underweight North America at the moment. It is the area we see the most risk under the current Trump scenario, and the economic outlook is the most unclear. And we are overweight emerging markets, in particular countries like Brazil.
What are the 5 big growth drivers for the infrastructure sector right now?
Absolutely, and this is an exciting part of infrastructure. Everyone considers it to be a nice, defensive, stable play, but you can't underestimate the importance of the growth thematics that are really driving the investment case. Now, there are 5 intertwined growth thematics that must happen. So the investment must take place. It doesn't matter who's running America. It doesn't matter where inflation is. It doesn't matter where interest rates go. So what are they? First and foremost, we have developed market replacement spend. Our infrastructure is old, it's inefficient, and it's falling down. If we do not replace it, we're going to have social and economic consequences. Secondly, we have population growth. It sounds so simple, but at the moment we have a population of 8 billion people. We're going to peak at over 10 billion, and we need infrastructure to support that population growth. Importantly, we have the East getting younger and the West getting older as well, and both of those dynamics require different forms of infrastructure spending. The third one is the emergence of the middle class in developing economies, with infrastructure being the first beneficiary and the biggest driver of the emergence of the middle class. Now, keep in mind that 85% of the global population live in the emerging world. You can see the evolution of that middle class, the importance of infrastructure in that dynamic. The fourth one is the energy transition. We've heard so much about net zero and decarbonisation goals that really infrastructure is a driver of that as well. We may have been a cause of some of the problems that we have today, but without huge investment in infrastructure and greening of the electricity or energy space and transport space, the world has no hope of net zero. And then the fifth big thematic, in which one is evolving quite rapidly, is technology. We've heard a lot about NVIDIA. We've heard a lot about Mag 7 and how exciting they are. What can derail their evolution is a lack of infrastructure. And that's twofold. You need communication towers for data, and you need huge electricity load growth to support data center development. So without infrastructure, you are not going to see the technology boom that everybody is waiting for. And maybe if I can just give you one quick example to bring these together. If you think about the Baltimore bridge collapse last year, that bridge collapsed because it was well past its useful life, so it was old and ready to collapse. That ship hit that bridge because it was under automation and it lost power for 30 seconds. So that one example shows you how important replacing our old infrastructure is. And if we want to rely on automation, then we need security of supply and no intermittency in our electricity grids.
So if you could, of the 5 big growth drivers that you just talked us through, can you walk us through one of those drivers in more detail?
Sure, and look, the one I'm going to pick is the emergence of the middle class, just because of the scope of it, and it actually intertwines with every one of those other thematics. Now, the emergence of the middle class is a phenomenal thematic in its own right, but if you consider all the population growth that we are seeing, that we just talked about, is coming from the emerging world. They're already 85% of the global population, and that is only going to grow. They currently have lower per capita energy consumption than we do in the developed world, and as they evolve, that's going to grow. That brings us into the energy transition and the technology boom as well. So just let's think about it very simplistically. If your wealth improves, your spending patterns invariably change. It starts with things like, I want 3 meals a day, things we don't understand. But over time, it's what I want: clean water, I want indoor plumbing, I want gas for cooking and heating. That's infrastructure. Once you have those services, you then want the washing machine or the dishwasher or the television. That increases the use of that infrastructure, but it also sees the demand for logistics chains and roads and port capacity to move those goods and services around the country. Over time, you might get the scooter or the car to travel to education or to employment. That, again, is all infrastructure. And over time, it expands to airports and exploring the rest of the world. So what you can see from just that one evolution is that infrastructure is the first driver of the emergence of the middle class and the biggest beneficiary of the emergence of the middle class. And again, I always love my examples, but just to give you, a couple, less than 10% of the Chinese currently have a passport. It's much lower in India. Yet pre-COVID, we had all the growth globally in air traffic was driven by the emerging world and the Chinese tourist. And in the last decade, the emerging market share of global air travel has doubled to over 40%, and that trend is only expected to continue. And you take that again just from a pure motor vehicle ownership. Less than 20% of people in China have a car. It's over 70% in the US. But annual motor vehicle sales have outpaced that of the US in China since 2010. Now, I don't care what you're driving. You can drive a Tesla or a Datsun Sunny. I don't care as long as you're driving it on my road.
Great. So can you tell us how you have invested in your portfolio to access this driver?
Investors can gain access directly through the emerging markets in both transport and utility investments, which we do. We do invest directly in the emerging world. If, however, people are unwilling to go directly into the emerging markets, you can access this thematic through global port capacity, global airport capacity, global gas and commodity transportation links, all of which are feeding into the emerging world or benefiting from the exploration from the emerging world. So you can capitalize it in-country or through external sources. As I said, they are 85% of the global population. They are too important to continue to ignore, and without understanding what's happening in those markets, you really don't have a great understanding what's happening on global landscapes.
How is your portfolio currently positioned for the market?
We are, again, looking through the volatility, looking through the sentiment and really digging down into fundamentals. We are investing against these 5 thematics. As I mentioned earlier, they are going nowhere. They must happen. But really, it is a combination of looking through the short-term noise, digging down into the fundamentals, looking at the earnings resilience, looking who can capitalize on the long-term growth thematics while still weathering the short-term cyclical impacts of the macro environment that we're currently facing.
Okay. So almost half of your portfolio is in Europe, 47%. What's driving that focus?
Look, Europe is a very diverse within its own region. It has a lot of user pays and it has a lot of utilities. So it has access to both elements of the infrastructure universe that we really want to look at. And it actually can also access in-country dynamics. Even within Europe, Spain is very different to Germany, which is very different to the UK. So we can access different regulatory environments, different macroeconomic scenarios, and different overall outlooks. As well as we think it's a little bit better able to mitigate the impacts of Trump. We prefer Europe over the US, both on a relative and an absolute valuation call, as well as that outlook at the moment.
Your biggest sector allocation is in electric and gas utilities. What makes this area so attractive?
I'm going to bring you back to those 5 thematics, and because, to be honest, the electric and gas utilities are linked or driving every one of them. So if you think about the replacement spend, what we need to replace is our grids, our networks, our power generation, our water supply networks, really to support the life that we live today. We need to replace what we've had historically because it's old and falling down, but then we also need to support what we have into this changing dynamics of the future global population. 2, population growth, okay? We're going to have 2 billion more people on the earth, and of that, they're largely in the emerging world, and they're evolving. They're going to want access to power. As I mentioned, they have 1/3 the energy per capita of the developed world at the moment, and that's just going to grow. So we need grids, we need power, we need supporting of that, we need security of supply there. We have the energy transition. If we want net zero, then we need to invest heavily into not only our generation sources, but into the security of supply and the networks and grids that actually take that energy supply to the end user. I think the energy crisis in Europe a couple of years ago really highlighted the need for security of supply, as well as the strengthening of the grids and the transition fuels to make sure that from a socially responsible standpoint, everyone has access to the power they need. And then again, that fifth growth driver, technology, that goes nowhere without huge investment in electricity grids. We need huge amounts of power to support the data center demand. Otherwise, the likes of AI fall over. And again, an example, I don't know if you were aware, but a ChatGPT search takes 10 times the power of a Google search. So if you have that sort of dynamic and that sort of evolution into the AI field, then you can see the quantum of power we need. The Baltimore bridge collapse highlighted that needs to be secure supply. If we want to rely on automation, that requires huge investment in grids, huge investment. And as an infrastructure investor, we get a return on our investment dollar irrespective of volume or demand. So it becomes a very attractive investment case.
Which regions or industries are you watching for future investments?
It is all around those 5 thematics, and as they evolve and as they get support from both regulators and countries as they look for their own goals. Clearly, we've had some significant country support across Europe and other parts of the world for the energy transition and greening of society. By contrast, in the US, Trump has walked away from clean energy and is very much more pro-fossil fuels. So from his standpoint, it's much more interesting to be in the midstream sector in the US at the moment and not in renewables. But by contrast, other parts of the world are very supportive of that energy transition as well. So we are very much focused on those thematics and then really looking at the in-country dynamics to find where we can best capitalize on the thematics and get the return that we need to justify investment.
Now, if you could talk us through specifically about your portfolio, if you could take us through your highest conviction investment and also a recent addition to your portfolio.
Our biggest position is actually a communication tower company called Cellnex. It is the largest communication tower company in Spain, or in Europe, and was the leader in really building out independent tower operations in the European region. It's actually been under a lot of pressure over the last couple of years from the interest rate dynamic and that perceived bond proxy, long duration assets style investment case. And we think the market has actually really missed the inflection point that is Cellnex and what we are looking forward to over the coming years. So all in all, in real summary for Cellnex, we think they're very high quality assets in a very high quality sector. We see a real strong free cash flow growth, supporting shareholder remuneration into the future. And it's ultimately supported by the fact that the market hasn't given them credit for that strength of earnings and growth, and it's offering a very attractive valuations.
Okay, great. And a recent addition to your portfolio?
Yeah, I'm actually going to pick an Australian one, so maybe people may know it. It's APA, which is the Australian sort of gas pipeline business. It's the largest monopoly gas pipeline business here in Australia. It itself has been under significant pressure for the last few years as people had concerns around the longevity of gas, as well as the balance sheet strength, as well as the strategic direction of the company with that gas under uncertainty. We took a position earlier this year, and really that position came about because we did clearly a lot of work, and we found that we got very confident in the competitive dynamics of their operations here in Australia, and it had been completely oversold. So our entry point offered us very attractive assets, very attractive risk reward, strong yield of 7%, and underpinned by a really good valuation moving forward.
Okay, great. So finally, in one line, we'll try anyway, why should investors include infrastructure in their portfolio today?
Look, very simply, I still think it's the investment theme of the decade. You have resilient earnings streams or visible earnings stream underpinned by huge growth dynamics and the ability to position for short-term cyclicals. And I don't think there's too many asset classes out there that can offer you that, which is defensiveness, growth, and the ability to weather the short-term cyclical storm that we're facing at the moment.
Sarah, you lay a very compelling case. Thank you for joining us in Livewire today.
Thanks for having me.
If you enjoyed that interview, make sure to give it a like and subscribe to our YouTube channel where we release new content every week.